All right. Good afternoon, everyone, and happy Friday. Thank you for joining us for our third quarter markets and economic update. This is Elier Peraza. I'm the Director of Financial Services at Johanson and Yau. Like always, I am joined today by our good friends from City National Rochdale, Poul-Erik, Olsen, and Robert Meckstroth. As you guys know, Johanson and Yau have been working with City National Rochdale for more than 17 years. So we have a very long history and a lot of mutual clients. So we relied a lot on their economics and portfolio management expertise. We have a lot to cover today, so I'm just going to go ahead and pass it to Robert. Robert, take it away.
Thanks so much, Elier, and thanks so much to everyone taking some time out of their Friday to listen to us today. Thanks for those who might be listening to this on the replay. Just a quick housekeeping item. If you're here live, there's a Q&A button on your Zoom dashboard. You can enter a question anytime into that. We should have time for any and all questions after we're done with the main presentation here. Again, there's a lot to cover, so I will just jump in without further ado. A couple things that we'll cover today. We'll hit on both economic outlook and some of the investment strategy. I think a couple big topics. One is the economic story. We just got GDP this week that was shockingly high, but we'll tell you why that was a kind of analysis of past data. What we're very concerned with is where we're going over the next 6 to 12 months. Inflation is going to be a topic, still elevated, but the path is headed the right direction. A lot of talk today about the Fed. There's been an extreme amount of volatility in long-term interest rates. The Fed controls the short-term interest rates, but we'll give our thoughts on the impact of what the Fed is doing and where we think they might be going before the end of next year. And we'll show our 2024 outlook today. We have that published now, our year-end forecast. We'll also talk about where there might be opportunities given everything going on in the world. Obviously, we'll hit on the geopolitical risks. We think there's still a lot of good, strong reasons to remain defensive given some of the risks out there in the world. Poul-Erik will go into that. But volatility sometimes creates opportunity. So I think there are a lot of strong companies here in the U.S. that have very good revenues, good potential for earnings growth. And if you see discounts on prices, that can be a buying opportunity in certain companies, certain sectors. I mentioned our 24 outlook. Here it is. You can see where we ended 2022, our final year-end 2023 outlook, and then our projections for next year. I'm going to focus mostly on next year. First off, you see the GDP number. We do expect positive growth for the full year 2024. Does not mean we necessarily avoid recession, but do think there'll be full year positive growth. The corporate profit number is interesting. Notice this year is basically flat at this point for growth in profits. Next year, a decent 6 to 12% growth expectation, even with all the economic headwinds that we're facing. Inflation, I think this is maybe good news or bad news, depending on how you're looking at it. Our year-end inflation number for next year is not at the Fed's 2% target, but it is down from where we stand now. Bottom line, inflation is going to be very tricky to get down to 2%, but we should make slow incremental progress there. And then finally, the interest rate forecast, which has been anyone's best guess on the long-term interest rates. We'll get into that. The 10-year has spiked. We hit 5% briefly. We've revised our 23 outlook, probably closer to the top line here. 4.75% is, I think, our best guess of where we end up on the 10-year. But probably see those rates slightly down through the end of next year. I do think 2 rate cuts on the Fed funds rate next year is a pretty consensus view, and I think it is reasonable, but it's probably the second half of the year where you see the Fed actually cut interest rates. Definitely don't see it anytime soon. So that is the outlook. We'll spend some more time on this data throughout this presentation, but I'll turn it over to Poul-Erik, the other portfolio manager who works with me, to go through the geopolitical risk section.
Yeah, so we're having this call at a bit of an interesting time. Had we had the call 2 months ago, everything would have seemed a little more peaceful. But the month of September was difficult, and some of the challenges have continued into October. So this chart has become a very relevant chart again, as one of the four blue squares go in and increase the financial market volatility. So what we have seen over the past 45, 60 days has been a move up in interest rates that has created some financial market volatility, increased financial market volatility, and then it's been exaggerated by the recent geopolitical events in the Middle East. And now we're sort of in a situation of just elevated uncertainty right at this moment, where if we've had the call 2 months ago, it would all have felt a little peaceful. But we do believe that most of the challenges we're seeing right this minute are challenges that don't really change the long-term trend, as Robert pointed out, of a slowdown in spending, slowdown in economic growth, and ultimately a lower inflation number before maybe later 2024 can look more promising. But let's tackle some of these issues, Robert, if you would go to the next page. So the one that's first and foremost on clients' minds, and we spend a lot of time talking about, is the geopolitical risk. And you can see here the indicator. It's hard to see. It's deep in red, and I don't know why it's not really hitting the full floor, because the world is a bit of a messy place at this point. But you can see the gray indicator, and if you can sort of see it a little bit above the black indicator, it's still moving in right to left in negative direction. And it's obviously the challenges in the Middle East exaggerated by a couple of other issues, which we'll go through on the next page. But there's no doubt that this is a significant negative, impacts market sentiment. But the question is it a long-term influence? So Robert, let's go a page here and just see what our challenges are. So what most people talk about at this point is the Middle East, and obviously it's logical: geopolitical instability, uncertainty about oil supply. How does it matter? Does it matter? And you can see the other two major conflicts that we're still needing to talk about, needing to consider. Russia-Ukraine has entered somewhat of a stalemate situation. Remember when that war first broke out, February last year, the significant impact on corn prices, wheat prices, oil prices, and it's an event to consider. But 6-9 months later, a lot of those prices had normalized, and that's very typical for a shock, a geopolitical event, is that the impact is firm, but also somewhat short term. The longer conflict, the third one that, if you really want to be more concerned about the world, China's actions with Taiwan, this is one that has a completely different impact than the other conflicts. This is a chip technology issue, right? Most people have heard of Taiwan Semiconductors. That is the biggest semiconductor company in the world, and tensions in the China-Taiwan region brings massive instability into the tech sector and semiconductors in particular. So all these three situations are something to consider, but as we've seen with many geopolitical events, you tend to, in my sense, exaggerate the impact of them, and typically they are short-lived in nature. Let's dive into the last one on the page and just spend a minute on the oil side of things. Yeah, you did good, Robert. So I often get sort of semi-strong reactions on oil prices, and you try and make the argument that it just doesn't matter so much anymore. A couple of slides here to confirm that our economy is not as dependent on oil as it was. Those of us that are in my demographics will remember the 70s, the oil embargoes, and all that mess. And when you look at the chart, you can see the 70s, 80s, oil was a meaningful part of our economy at around 6% of GDP. And we did a lot more manufacturing back then. Our economy has evolved. We're doing more of a service economy. how we utilize the efficiency of autos, efficiency of what do we call appliances, the onset of electric cars. We're just a little less dependent on oil and natural gas than we used to be. And as I said, it's partly because the nature of the economy has changed. And Robert, if you go to the next page, and then our consumption pattern has also changed. You can see here, this is what you, me, and everybody spend of our money is spent on energy. And it is just downward trending. You go back to the 60s, 70s, 80s, where it was in the 5 to 7% range, and you look at where we are now, really down around 2-3% of our consumption is spent on energy, and it's just a much lower number. We're much less vulnerable to movement in energy prices than we used to be, and that just means when you have an oil crisis, oil prices go over $100, it just doesn't matter like it used to back in the 70s and 80s. The geopolitical event, just to round off my thoughts on the geopolitical events, we put together this slide. If you would go jump one, Robert. This slide's a little bit busy, but let's see if we can make sense of it. We're basically trying to make the argument that if the economy is strong, the ability to sustain geopolitical shocks has been historically better. And you can look at all the crises on the right here. There sadly has been a lot of them over the past 40 years. And what we're showing is when the event happens, 1 week stock performance, 1 month stock performance, 3 months, and 1 year. And for most of the situations where the economy was in good shape, a year later, the stock market is actually doing quite well, it has moved forward. But there clearly are also situations where the economy was vulnerable and where the direction was the opposite, and you've seen negative performance. Currently, we would say the economy is strong, maybe heading into a slight slowdown, but we're not in a recessionary state as these crises come upon us. And that leads us to believe that the geopolitical is important, can have short-term negative consequences, but the long-term picture, when the economy is strong, does not seem to be a negative one. So it's not one we recommend to take action on, reallocate the portfolio, be more defensive. That's not the recommendation.
Yeah, I think it's well said. I think sometimes the geopolitical events make so many headlines, and I'm getting more questions on those than anything else, where I think the bigger impacts to most investors' portfolios are some of the domestic issues like economic growth, interest rates, and what the Fed is doing. And specifically, the U.S. government is the other source where I'm getting a lot of questions, the domestic political environment. The good news is this slide was put together during the period of time where we didn't have a Speaker of the House for a couple weeks. That has now thankfully ended. I think very important to have a Speaker of the House, especially with a looming government shutdown. So there still is the shutdown risk. I think that is present. We could have a shutdown sometime in November, and I get this question a lot. What would be the effect of a shutdown on market conditions? We can look to a couple different shutdowns, 95, 13, 2008. They typically have a small impact on GDP, but typically not a huge one. And typically the economy bounces back once the government is reopened. When we look at the change in the markets during this time, you can see some volatility around, especially in 2018. That was the big one. The other ones really didn't move the markets much at all. But in 18, you saw markets drop 20%, only to rebound almost immediately after the government reopened. So if we did get into a shutdown period, kind of similar to the geopolitical stuff, you want to focus on fundamentals, I think, as opposed to trading just based on the government action. But I think the one government situation that's a little more pressing than the shutdown stuff is the debt issue. Because I've been saying this for years, that we obviously have a debt issue, and it's been the story for many years at this point. But I've been saying the debt issue doesn't really matter until interest rates come up. And why have I been saying that? Because it all comes down to the cost of servicing this debt. And the total deficit right now is $33 trillion as of September. That's a record deficit. But the problem is to finance this deficit, it requires us to issue government bonds. That's how we fund the government. We issue treasury bonds, and then we owe interest on those treasury bonds to investors. When a 10-year treasury is paying 1%, that interest cost isn't too bad at the end of the day. But now the 10-year treasury getting close to 5% on a debt level that we have now, it becomes a bigger and bigger expense when it comes to our national spending. And I believe we're in the range of $500 billion a year just in interest payments on our debt. So it becomes very, very tough to cut spending when a big part of that spending is just interest on the debt that you can't really control. It's going to be a massive issue in Washington for years to come, and we'll be watching it closely. But I think, again, market-wise, is it going to affect the profitability of companies from a stock market standpoint? I don't necessarily think so. So when you look at investment portfolios, the deficit being an issue does affect government spending and a lot there, but I don't know how much it affects the average day-to-day company when it comes to making profits. What does affect day-to-day companies is where interest rates are and where the Fed is going. And what we've seen right now is all the discussion has been on what the Fed is doing in short-term interest rates. As a refresher, the Fed controls the Fed funds rate, so the short-term interest rates. Think of what you get on a CD at the bank. Those are almost directly affected by Fed decisions. The 10-year Treasury is more affected by market forces. I just talked about it. The government is issuing these 10-year Treasuries to fund operations. These can go up or down no matter what the Fed is doing. And the big story in just the last couple weeks has been these 10-year Treasuries have exploded higher. And if you've been really following the financial news, they've thrown out this term a lot, which is, the term premium has increased. Basically a measure of, how much do investors need to get paid extra to own 10-year bonds instead of shorter term bonds. And investors have demanded a lot more interest on these longer term bonds just in recent weeks. So a lot of chatter to why that is. I think you've listened to Janet Yellen this week. She's commented on this and said the strong economic growth is a big reason for this. It's not necessarily because of worries about, deficits that are causing this to spike. Yellen was quoted by saying it's because the economy is stronger. We think that interest rates are going to have to stay longer based on inflation not coming down. So, that's Yellen's view. I think our view, we'll talk about it, might be a few more factors, but it's interesting because when these 10-year Treasuries go up, that puts additional pressure on the economy on top of what the Fed is doing with short-term interest rates. What interest rate is tied more to 10-year Treasuries? The 30-year mortgage. 30-year mortgage getting close to 8%. That's a nasty number if you're a first-time home buyer or looking to buy a new home right now, considering we just had sub 3% mortgages. The Fed actions definitely have effect on not only the economy, but can trigger issues. If interest rates are going up and you don't have your house in order, oftentimes the interest rates going up is the trigger that causes something to go bad, something to break in the economy. And what this chart shows is all of the different interest rate hike periods over time. I mean, it's just wild to see we had zero interest rates for almost a decade, but we did. But notice every time interest rates go up, typically there's a few things that go wrong. This time around, we had the banking crisis. I mean, Silicon Valley Bank, First Republic Bank, these institutions failing were a direct result of interest rates going up. Some mismanagement, of course, but if interest rates hadn't gone up, you wouldn't have seen it. I mean, it's part of what comes with trying to slow the economy from rising interest rates. There's potential for things to go wrong, and the Fed is willing to accept that in the fight against inflation, to bring inflation down. Good old good old Toys R Us. It's nice to see that on the page back in 2018. A sad story there. Although the brand lives on, somewhere out there. I think there's some talk about bringing it back to life. But anyway, financial conditions index. This one is fascinating to me because what Goldman Sachs tries to do with this indicator is kind of give you an idea of how tight are all financial conditions right now. It's not just what the Fed is doing, but things like 10-year treasuries and where stocks are valued. A lot of things go into their model. What's very interesting is, first, you can just see how easy financial conditions were for a while after the pandemic. I mean, amazing to see how long that lasted before the Fed had to really catch up. You could certainly argue that there were policy mistakes being made by the Fed during this period where conditions got so easy. But look at now, how quickly those went up. We've now seen tighter conditions kind of starting at the back half of 2022, and now those conditions are getting tighter. So when we talk about the good economic data that's been released in the last week, it's amazing that that's coming out in the face of these tighter conditions, but the longer conditions stay tight, the harder it is to maintain that level of economic growth. So I think it's almost a certainty that we see the economy slow down. It's just a question of how slow does it get? And I think the good news is very little risk of a major recession at this point. So, not going to talk about this one too much, but when you have periods of geopolitical uncertainty, like Poul-Erik said, one of the moves you can make is just focus more on U.S. markets. I think that's a very logical approach, and this year that's been the winning play. I mean, you see S&P 500 versus Europe versus Asia. It's been dramatic outperformance here in the U.S. This mainly is a tech story. The big 7 tech companies have rallied, and that's pulled U.S. markets up. But I think this can continue, especially with all those global risks that are out there. U.S. is more insulated from some of the risks, again, when it comes to our day-to-day companies. So I'm going to pass it back to Poul-Erik. We've referenced some of the good economic data. I'm going to have him run through a couple of the consumer slides, and then we'll get close to the Q&A section.
So Robert, sorry to do this, but just go back to page 14 for just a second. I just want to make sure that there's not confusion. I don't think you even noticed it, but you mentioned that the deficit was 33 trillion. And just so there's no confusion, actually the debt that's 33 trillion, we're running deficits of 2 trillion up from last year, 1 trillion. Just if anybody sat out there confused about the concept. So the deficit is obviously what we spend every year more than we get in tax revenues, and the total debt is what was all about the debt ceiling and all that, just in case anybody paid that close attention.
Well, we have CPAs in the room, so.
Yes, so someone might have caught it. So just for good bookkeeping, so the debt is 33 trillion and the deficit is 2. So let's get into the consumer spending story. So what I think one of the things that has surprised the Fed, has surprised most analysts, is just how the consumers continue to spend money. In September, we got a stunning growth in retail sales of 4.1%. We're still spending. I don't know if it's Elier spending or it's Robert spending, but we're all traveling. We're all spending money on services. We're going to games, concerts.
Taylor Swift.
Yes, I didn't spend. I said no to my 10-year-old, but a lot of others said yes to their 10-year-olds. I know that. Amazing what you can get for $1,500, Elier. But that's besides the point. So, what sort of defies belief is just how much we spent. So, for this chart we're showing here is just a long-term spending pattern in the light blue line here, and you see it's trending very steady. It doesn't really dramatically deviate unless there's a pandemic going on, which is the little V tooth you have down in 2020. But you can also see, if you look at the disposable income, how much money we have to spend was really helped with the 3 stimulus checks. That's the 3 spikes you see in the top line. But when I look at this chart, I'm looking, disposable income is going below the long-term trend line, and yet our spending is staying on trend. What does that mean? That means we're slowly starting to eat into our savings. And when you see that, you would think, well, gosh, that can't continue to happen. It has continued to happen, but at some point, the consumer is really going to run out of steam, because you can't continue to just have a lower savings rate than the long-term savings rate in system. Eventually, that would be replaced by debt. And so we often get the questions in meetings, well, isn't there an explosion in credit card debt? Not really. There's an increase in credit card debt. Surely there always is, but the delinquencies are not really a concern. Then you see headlines, delinquencies up dramatically. True, but they were at a historical low. Coming out of the pandemic, delinquencies on credit card debt, auto loans were at historical lows. And all we've done is just moved off those historical lows and getting closer to a more normalized delinquency situation. So there's not really a problem for the individual person on the credit side, but there's a concern on the amount of money we spend compared to the amount of money we have to spend. So let's dive, the next chart goes a little deeper into this. And you can just see spending as percent of income. Robert, if you can highlight sort of the 22-23 pattern we're seeing, where our spending is above trend line there. And that's basically what I was talking about. Is it does feel and look like we're spending money we don't quite have, or we're eating into our savings, or we're not saving what we need to save for sort of long-term normal spending habits. One of the reasons we can get away with this is because jobs are strong. Job creation has been sensational. Robert, if you go to the next slide, we can see the job in the growth in jobs, or payrolls as it's called. Monthly number, the dotted line, is about 190,000 new jobs a month. And that's sort of the average of 4 million people leaving the workforce, 4 million people getting a new job. And that nets out to about 190,000 in a net positive. Look at the post-pandemic numbers. Obviously, logically, with all the people laid off, hiring exploded. And it has stayed amazingly strong, even as consumer spending sort of is coming to its last gasp. Inflation is higher, interest rates are higher, job creation has still been strong. So if you wonder how can people still get away with spending, well, people have not exactly lost their jobs. Anybody who wants to work, largely there's a job for you. So if you go to the next page, and if we go in a little deeper into that, if you look at the chart on the left side, look at the crazy amount of job openings we had. We peaked in March 2020 when we had 12 million in open jobs. There were 2 jobs for every person looking for jobs. It was nuts. But what has happened over the last year or so is that it's trending down to a more normalization of what everything looked like. And the ratio now is moving down towards 1, but it's still clearly an overheated job market. There's no doubt about it. Another data point for that is the job quits rate. Coming out of the pandemic, you can see it spiked at 3% in the job quits rate, basically because people moved to Wyoming or wherever you needed, took a new job, and was sort of very comfortable that there's a job for everybody with all the job openings. That also is moving down. So what you have in this overheated job market that probably has led to some extra spending is it's all trending to a more normal situation. And that's just pointing to the consumer ultimately running out of steam, spending less, and that will help inflation ultimately move down from the 3.5% level we're at. So what the Fed needs to see on the job market in pay growth, if we look at the next slide, Robert, you can see here, this is an important notion. If there's any geeks out there that follows this a little too closely, in the monthly job number report, there's a payroll growth and wage growth number. You can see it's the average hourly earnings in the light blue. That also gets reported with a monthly jobs report. And we have highlighted that shaded area that's 2.5 to 3.5% wage growth. that the Fed is comfortable with, because that level of wage growth translates to about 2% in inflation. That's how the numbers connect. But if you look at the chart or the graph lines to the right coming out of the pandemic, we have trended 5-6% in wage growth for an extended period of time. That's where the Fed is really worried about inflation. If wage growth is trending that much about what is a natural wage growth number. But you can also see in 2023, they're all downtrending, and that supports that picture from the jobs numbers and other indicators that we've gone through a rather extreme scenario post-pandemic, spending, job growth, payroll growth, wage growth, but it's all normalizing and trending downwards to what ultimately should support inflation coming down and ultimately go down closer to 2% than the 3.5% number we're at the moment.
I think well said, Poul-Erik. I think I'll wrap us up with just a couple more to make sure we have time for questions. As a reminder, if you do have a question or comment, just click on the Q&A button on your Zoom dashboard and you can type it in. You can have your name tied to it or make it anonymous, up to you, but we'll have time to answer some of those in a second. But, so all that economic story, what does it mean for investment positioning? A couple quick ones. This is an interesting chart. It shows the 1-year returns when you're coming off of the bear market low. At the moment, our bear market low was September of last year. So if you look at the S&P 500 is up 20% from the absolute low in 2022. The S&P equal weight's up 11, and small cap stocks are still very depressed. They're only up 5% from the lows. Compare that to many other periods, and you'll see we're trending below average. To me, I see a little opportunity there. When you see stocks still depressed, you tend to want to look for those opportunities because often the best buying opportunities are coming out of those bear markets. But if you're looking for buying opportunities, we want to focus on quality companies right now. This is not the time to get out over our skis chasing companies that have low revenues and high risk. If you look at our quality rank, we compare both our equity income strategies and our core equity strategies. Our strategy here is the quality rank here, the dark blue versus the light blue. As you can see, we're higher on quality. And then if you go over to our expected growth rates here, our growth rate is actually slightly higher than what you'd expect with the S&P 500. This is earnings per share growth rate. So this is kind of what our research team is trying to lock us into is higher quality, lower risk type stocks, but not sacrificing potential growth. And I think that's the right play is when there's times of uncertainty, with geopolitical risk, with government deficits, I always go back and say, does X company, what is their profits going to be affected? Are people going to continue to shop at this specific company? If the answer is yes, then you're more comfortable holding those stocks in tougher environments. We talked about this one, why the 10-year yield is surging. We already kind of went through that already. But the last thing I'll leave with, and then we'll get to questions, is just what's been going on in the bond market, which is wild. This chart shows the calendar year returns for bonds going back to 1980. The blue bar is the year-end return for bonds, aggregate bond index, so an average bond portfolio. The worst bond year since 1980 prior to recent times was a -2 in the early 90s. Fast forward to the last 3 years, you'll notice something completely different about the last 3 years. 3 consecutive down years in bonds so far, with that -13 mixed in, which is the worst year ever for traditional bonds. It's been a bloodbath for bonds with interest rates coming up. Now, the good news is when bond interest rates go up like they have, and this pain has been felt, it's a fantastic buying opportunity for conservative investors that might be looking to save money at higher rates. I've been with the company 13 years. It's by far the best buying opportunity for bonds we've seen. if you're comfortable collecting interest and calling it a day. So for conservative investors right now, we're looking for these buying opportunities. And, I get the question a lot, well, is there risk? Can these bonds go down another 13%? When you gain your confidence that the Fed is going to be ending their tightening cycle soon, that interest rates are close to peaking, then your downside risk in bonds is so much smaller than it was 3 years ago. So the trade-off is you don't have the upside that you have with stocks in terms of growth, but anytime you can lock in 5+% in a traditional bond strategy and have lower downside risk, it can be a temptation if you're looking to save money. So with that said, I'm going to turn it back over to Elier just to see if any questions have come in. As we take questions, I will cycle through some of the disclosure pages we need to go through. But Elier, any questions you've seen come in so far?
Yeah, so I have several questions. I asked people before, to send me questions, and I have a couple of them here, or actually it's a handful of them. So you touched base very quickly on the Silicon Valley Bank event, and so we were lucky enough. We, as portfolio managers, we were not affected by it, that much. But living in San Jose, we had a lot of clients that were affected by it because they were using the bank for paying bills and payroll and all that kind of thing. Well, if we continue at this very high interest rate environment, is the banking sector now out of the weed, or are we still at risk, especially, like banks like Comerica Bank and regional ones?
So I can tackle that. I work with a large number of credit unions and deal with this stuff on a almost daily basis, Elier. It's a tough time to be a bank, right? It's because the funding cost on the deposit side has gone up dramatically, and the loan demand is softening. But the banks are still making money, and the big banks are making more money than the smaller banks. The big banks have the advantage of a more diversified revenue stream. So you look at JP Morgan and Bank of America, you have investment banking business, you have asset management business, you have a lot of different non-traditional bank businesses that help diversify. But the pain in the regional bank side and the mid-sized smaller bank can be a little trickier if you have sort of overextended yourself. Maybe you sit on a lot of low rate auto loans and you now got to finance yourself with higher deposit rate. That can be difficult. But broadly, I see, Elier, most have adjusted, right? So most are still able to be profitable in this more difficult environment. But there's no question for the banks that sort of do traditional banking business that this is difficult, because your deposit, as deposits mature, they got to be rolled over and you got to pay 5%, maybe more for it. Your auto loans, you're hoping to scrape out 8% and be profitable. So it's just gotten more difficult. But I think the sort of alarming shock to the system that were the bank's bond portfolios, I think that's behind us. So I think it's not a blow up risk that you're facing. I think it's more an income profitability challenge that these banks are sitting on and are facing. But hold your breath for just a second. That is right now, that's probably the next 6 to 9 months. But then remember, what is the best of times for banks? The best of times is when rates have been high and are moving down, because there's stickiness on the loan side while the funding side comes down immediately when rates move down. So maybe a year out or so, when comes more demand for loans, loan rates are still, borrowing rates are still somewhat high and deposit rates are coming down. You could have a real sweet situation for the financial institutions, but it's probably a year out, I would think, before that kicks in.
Okay, well, I think this is a good segue, but because one of the questions I have also is, when do we think interest rates will start going down? And are we ready to go long on the yield curve if we have cash to deploy?
That's a good one. I love the second part of that question about where to target the bonds. I referenced the good buying opportunities, but I didn't reference exactly where to target the duration. So I think the first answer to the question we covered a little bit. I think the short end of the curve is a little clearer. in that the Fed's probably going to keep rates where they are, max one rate hike in the next couple of months, and then likely 2 rate cuts sometime in the second half of the year. So I think the short end, pretty clear, but the long end is where you have the uncertainty. It's anyone's guess on the 10-year Treasury. I mean, you can lock in 10-year Treasuries at 4.8%, but the yield curve is still inverted, because if you're going out and buying bonds right now, you can pick up, say, bonds 4, 5, 6 years out and get paid more interest than what you're getting on the 10-year. So I think it really depends on your risk profile and your goals about where you target. But I think a sweet spot for a lot of people is kind of that 4 to 6 year maturity, because you get the benefit of that higher rate of interest than what you'd get on longer term bonds. And you get a little bit more protection too, because again, if something swings where interest rates on the long end spike again, you're not going to have as much variability in those bond returns, in those kind of short intermediate type bonds. And you also have the benefit of, locking in those interest rates a little longer than going to ultra short term, like 6 month or 1 year CD type stuff.
Just to add one little comment to that, do remember that the municipal bond market looks completely different from the government bonds. So whether you're buying taxable bonds or non-taxable bonds really makes quite a difference. What Robert talked about really was mostly the taxable government corporate bonds, where there really is, for the interested investor, plenty of liquidity in 6 and 12 months paper. But if you're a municipal bond investor, there's just not that much paper there. So if you are to build a municipal bond portfolio, really hard to do without going a little longer out in maturity. So for those of you that might be clients, you wonder, well, why does it look one way on the taxable side and one way on the muni side? It's just really different market conditions. There's a gazillion billion T-bills to be bought, but there's not that many short-term municipal bonds out there.
Yep, that's
Great
right.
point.
All right. The next question I have is, can we expand a little bit on the difference that we're seeing between, let's say, the S&P 500 and the Dow, or growth stocks versus value? And since we're here, let's talk a little bit about artificial intelligence and what happened during the summer. You guys didn't mention it throughout the presentation, and I know that question is out there.
I can start, Robert. I'm sure you have a couple of comments too as well. I mean, the artificial intelligence play sort of exploded around the second quarter of this year. And those of you that are familiar with the stock NVIDIA that makes the semiconductors, that is part of the solution for artificial intelligence applications, stock exploded up 200%, just over extreme demand. And it spilled over somewhat to Microsoft, which was viewed as, on the software application side, maybe being positioned the strongest. And then it sort of pulled, for various reasons, the big tech names up. And we've had a total domination of the 7 big tech names, the Magnificent 7 or the Tech Titans, or you name them. And they're totally dominated performance for the year. But it has softened. We have seen declines in Apple, we've seen declines in Google, we've seen declines in Tesla. And where it was sort of an extreme situation on the stock side, it has modified somewhat. But the difference between those 7 names, tech generally, and the broader market is still completely there. And it's a weird year. So you ask, is the stock market doing fine? I'd say, yeah, if you have the 7 stocks. Outside that, really not a lot to been found for the year in terms of performance. And so clients can have wildly different experiences depending on which part of the stock market you've been involved with.
Yep.
Yeah, and the only thing I'll add to that is just, when it comes to, a lot of times they'll say it's a stock picker's market. I think there's a lot of that right now, because you've seen, even though the tech stocks have pulled back a little bit recently, they've still had a strong year and their valuations have gotten more expensive, where some other sectors of the economy, banks, utilities, consumer staples, you haven't seen horrible earnings, but you've seen a lot of negative moves in the stock price, making their valuations cheaper. So you have a big difference depending on the sector of the stock market when you're looking at just pure valuations on stocks. So I think our research team has that as a thought process when we looked at the type of stocks that we're looking at. We definitely want to consider valuation on top of growth when it comes to these. And, you know, the AI story is what's driven a lot of that, you know, heightened growth expectations. But when you see your stock surge, I mean, Google saw it this week. I mean, Google's earnings weren't horrible, but these expectations are that AI is going to start to move the needle and make these companies more profitable. And it really hasn't yet for Google. So eventually you have to see the profits from these emerging technologies. And I think, you know, with Microsoft, it's been a little bit of a different story in that Microsoft has gotten a little more out of their AI plays early on. So I think we will look back and say this was the start of a real game-changing technology that's not going anywhere. But we'll also come back and look at a lot of companies that said a lot of things they were going to benefit from AI that did not, and did not get any extra profitability about it. You got to be very careful in investing in the space.
Yep, I agree with that. The very last question I have here, it's regarding international exposure. So you guys are very unique on the strategy that you've been out of international for a while versus other money managers that we work with and we follow. When do we think you guys will start looking into going back to international?
That's a good one.
You and I might be retired before then, Elier, I'm afraid. Just think about what it is you need to be excited about international, right? You need some combination of valuation or underlying strong economic growth. And so I think most can agree that, and here I'm thinking primarily Europe, but you can really apply these thoughts to China and other regions too. Growth is a problem compared with US economic growth. It just simply is not as strong. And what most don't realize is that 2008, a big financial crisis, and post 2008, the US economy had just done differently what most other economies over the world has. They have just not grown like the US economy has. And there's no reason to believe that there's going to be some big equalization. So the first thing you need to see is some conviction that the Swiss economy or the French economy or the Taiwanese economy is going to have some unique growth pattern that really is stronger than the growth we see here domestically. And it hasn't really been the case. The second part of it is, well, gosh, what if these stocks are really cheap? Well, there is a point where that is an argument for buying them. But the analysis we have done really shows that if there's not that many tech companies in Europe. If you sort of normalize the two stock indexes and make them look the same, our value stocks, our energy companies, utility companies, consumer companies are valued roughly the same as Europe's are. So this notion that Europe is cheaper doesn't really quite hold. So Elier, it would take some valuation disparity that was too good to pass up, or a different view on the growth outlook of some of the international economies you could look at. There was a half an hour earlier this year, I'm being a little bit funny here, but where Japan looked attractive. It looked like, gosh, could Japan really break out of sort of this economic slump that has lasted 30 years? Japan is benefiting from the diversification away from China in many ways, and people got a little excited. But then fast forward, and now the inflation numbers are super low, the spending numbers are low, and the Japan story is not really happening. So we're US-centric because the US economy just has performed better, not because we live here, but just because it just simply has performed better.
Yep, I agree.
The only thing I'll just add one more point that's made it a little less urgent for us to move into international as well, is that just knowing these big US companies we talked about are such global players now. I mean, those big 7 tech companies, the revenues they're getting outside the US are enormous. So you have much less urgency to go out and say, I need to go buy a basket of European stocks or a basket of Asian stocks, knowing that a big chunk of the portfolio we own is generating significant revenues overseas. So even if those regions come back and you get better sales and better consumption, you're going to indirectly participate that owning big global US companies that we like.
Perfect. All right, that is a good wrap up there. That I had about 13 questions, but you guys addressed most of them throughout the presentation. These 5 or 6 were the ones that were not addressed. So I would like to thank you so much. Like always, these events are a lot of fun for us. And for those of you listening, we are recording the webinar. We're going to send the recording out. And also we'll send it to all our clients. So Robert and Poul-Erik, thank you so much, sir.
Thank you, Elier. Good time. Thank you.
Bye-bye, everyone.
Take care. Bye-bye.